Homeowners insurance is a policy that protects your home and belongings from financial loss due to unforeseen events. If you have a mortgage, you need insurance because the lender will require you to protect the asset as long as you owe them money. You can take out an insurance policy on a home, a condo, as a renter, and as a landlord. The idea is that you're protecting yourself from liability and loss from whatever risks you're exposed to. To make things more complicated, there is no set price for insurance. What it costs will depend on the kind of coverage you have, how much you insure, and your overall risk profile. The absolute cheapest insurance may not protect you the way you need to be protected, but the most expensive insurance might just be throwing money away because it covers stuff you don't need. That's why knowing what you need and then shopping around is so important. Of course, shopping around only works if you know what to look for, and homeowners insurance can be confusing. Where do you start? We're going to start with what homeowners insurance covers and what it doesn't cover. A standard homeowners insurance policy has 6 different coverages that are indicated by the letters of the alphabet from A to F. Coverage A is for the dwelling. If something were to happen, the insurance policy would cover repair or rebuild. You don't get a check for the value of the property, just what it would take to rebuild the structure. Coverage B covers other structures on the property, like sheds, fences, pools, and that Lord of the Rings themed gazebo that you just had to have. Coverage C covers the possessions you lost in the event, like your laptop, furniture, TV, and clothes. All the stuff. There are 2 ways you could be reimbursed for the lost property: replacement cost and cash value. Replacement cost is better because it means that the insurance company will give you the money to replace that laptop. Cash value would just reimburse you for what that 5-year-old laptop is worth today. Coverage D covers additional living expenses. If you have a house fire, you can't live there while the house is being rebuilt. So this insurance gives you living expenses so that you can rent another place. It can be financially devastating to have to pay your mortgage and rent an apartment while your home is being rebuilt. Coverage E covers personal liability. This covers losses that other people experience on your property or because of your neglect. Your personal liability coverage protects you if your dog bites someone. Maybe a tree on your property falls and damages your neighbor's roof. Maybe your spiteful uncle comes over for Thanksgiving dinner and trips over your rug, breaking his arm. He sues you for psychological damage. He'll never be able to look at another Persian rug again without trauma. Finally, coverage F covers medical expenses for accidents that happen on your property. This would be to cover your uncle's ER visit. It could also cover a delivery person's medical care if they slipped on some ice in your walkway. What this doesn't cover is your own injuries. That would be covered by your health insurance. There is also something called umbrella coverage, which gives you extra liability protection. Umbrella coverage typically kicks in when the liability limits on your primary policy are exhausted. It can be especially important to people with substantial assets that need to be protected. All of this sounds pretty comprehensive, but there are things that the homeowner's insurance does not cover. Some of the risks that are usually excluded from homeowners' policies include flood damage resulting from heavy rain, storm surges, or rising water levels, earthquake and ground movement damage caused by sinkholes and landslides, normal wear and tear such as general deterioration like an aging roof, plumbing corrosion, or settling foundations. Similarly, neglect and poor maintenance is not covered. This might include mold growth, termite infestations, or water damage from unrepaired leaks. It probably doesn't surprise you to learn that you are not covered for intentional damage that you or a household member causes to the property. Most policies will also not cover government actions like confiscation, demolition, or property seizure, or acts of war. They also won't cover business-related losses that arise from a home-based business. You would likely need a business rider or get a business insurance policy to cover that. Certain types of water damage like sewer backups and sump pump overflows are also excluded as well. Finally, luxury or high-value items like jewelry, fine art, or collectibles usually need to have a specific rider to be included. There are even some other exclusions that could pop up. So you need to check your insurance policy's fine print to determine if you need coverage for anything that would be excluded. There is usually a way to cover any eventuality, but it might require a specific rider on an existing policy or an additional policy altogether. About now is when a lot of people start to get a bit overwhelmed. It feels like so much. How much coverage do you really need? How can you know what is important in your situation? One way to answer this question is to go back over coverage A through F and make note of how much coverage you need in each of those sections. That will help you put together a framework for the minimum coverage that you would need. Next, think about what is not covered by standard policies to determine whether you need to supplement it. The most common supplements are for flood, earthquake, and luxury or high-value items. Then you need to give some thought to your deductible. The deductible is the amount of money that you have to pay upfront for a disaster before the insurance kicks in. The higher your deductible, the lower your monthly payment. Think of homeowners insurance as something you hope never to use, so it's okay to have a higher deductible. After all, you shouldn't file claims for minor things anyway, but you don't want your deductible higher than you can reasonably handle. If your deductible is too high, the disaster could be financially ruinous, even if it isn't catastrophic. When it comes to figuring out how much coverage you should have, I have a cheat code for you. The best thing you can do is get an independent insurance agent. An independent agent is someone who does not work for a specific insurance brand. That's important because it means they can shop you around to several different carriers and get you the best deal. They also don't care if you go with company A or company B, so they can talk you through your needs, answer your questions, and advise you on what would be best in your situation. When you work with an independent insurance agent, you don't sign a contract. That means you're never under any obligation. If they can't help you, don't use them. If you want to look for an independent insurance agent in your area, you can go to the Yukon Project. Sign up at our insurance agent search, and we will have a partner contact you. They have relationships with almost 200 insurance carriers in the country, so they can find the perfect match for your situation. Signing up will only take a couple of minutes. You will get personalized service, so it's a great way to gain confidence that you're getting the coverage that you need at the lowest possible price. Okay, we know what insurance covers and what it doesn't and how to go about shopping for it. The next obvious question is, what's it going to cost? In the language of insurance, the cost of the policy is called the premium. The average premium in the United States is somewhere between $2,100 and $2,800 a year. But as you can imagine, that average isn't terribly useful. Some states are more expensive than others. For example, Oklahoma has the most expensive rates in the country, and Hawaii has the lowest rates. Obviously, the value of your home plays a huge role as well. The average insurance premium for a $200,000 home is $1,900 a year. The average premium for a $600,000 home is $4,000 a year. You can pay the premium as a monthly bill, or you can pay it bi-yearly or even yearly. You can often get a discount if you are willing to prepay for 6 to 12 months. If you have the money on hand, it can save you a lot of money and hassle to prepay that bill. The size of your premium will depend on your home value, where you live, the amount of coverage you need, the size of your deductible, your credit score, and your past claims history with the company. You can also be pretty aggressive about hunting down discounts that the carrier might offer you. All carriers offer discounts. Some common discounts include first-time home buyer, updated elements like roof, plumbing, electrical, and heater, paperless discount for conducting the business digitally, not carrying a mortgage, affinity groups like AARP, industry groups, or military affiliation, high credit score, being a non-smoker, and finally, you can often get a discount if you use the same company for your auto insurance. And I'm sure you've seen that advertised. There's a big movement to bundle your insurance so that the company can gain efficiencies. Believe it or not, bundling could save you 20 to 30% on both car and home insurance. An independent agent can tell you about all the discounts the carrier offers and help you identify what discounts you qualify for. Let's hope it never comes to this, but what happens if you need to file a claim? What's that process all about? The first thing you want to do is document the damage. It's also important to get a general ballpark of the cost of the damage. You will want to review your policy to understand how the damage is covered with your policy. If the damage is catastrophic, it's good enough to know that the cost of the damage is multiples higher than your deductible. If the damage is at or around your deductible, you may choose not to file a claim, as doing so will almost certainly cause your rates to go up when you renew. Most insurance companies have a hotline that you can call when you think you need to file a claim. They will take the information and it kicks off the process. They will send an insurance adjuster to assess the damage. They will assess the claim against your policy, and then you will receive a payout. You've heard me say it a couple of times, and I'm going to say it again now. All of this is made much easier if you have an independent insurance agent. Why? Because you can just call them when you run into an issue, and they can walk you through the whole process. They can explain your options, and if something happens, they can even file a claim on your behalf. Here's the other thing. You don't want to actually call your insurance carrier to talk through the issues, because the insurance company will count that call as a claim when they reassess your rates at renewal. If the call doesn't result in a payout, they tag that call as a $0 claim. That's right, just talking to the insurance company can cause your premiums to go up at your next renewal. So it's nice to direct your questions to your independent agent instead of your carrier. For your independent agent, there are no $0 claims or no claims at all. The claim is against the insurance company, not the agent, so they can be your safe space. Homeowners insurance is necessary and can give you a lot of peace of mind, but only if you feel like you have what you need and you're not overpaying. Remember that insurance is all about protecting yourself in case something goes wrong. You hope and pray that nothing ever does go wrong, but if it does, you can feel comfortable that you have the protection to be able to recover. If you have any questions, leave a comment below and we'll see if we can get the question answered for you. If you found this information helpful, please like this video and subscribe to our channel. Your support helps us out and we appreciate it. Thanks for watching.